Most investors are chasing the wrong stocks and it's killing their returns. In this video, I'll show you exactly which stocks to avoid if you want to grow your portfolio by 30% a year, just like we do. And more importantly, I'll walk you through the repeatable pattern behind stocks that go up 1,000%, even more. This method transformed how I invest, and I'm giving you the exact blueprint. So let's get straight in. Now, every stock that has made it into my portfolio follows a very particular pattern, a simple and repeatable pattern that's easy to recognize and busts the myth that stock picking is impossible. And here's the best part. I'll show you exactly how that pattern works so you can use it yourself by the end of this video. Okay, so the first stock you want to steer well clear of are stocks that are dropping in price, or going for that famous phrase, a discount. Probably not something you thought you'd hear. Think about it for a second and objectively, because this is what we must do as investors: remain objective. There is no room for emotions. We must focus on what the stock is doing and not what we want it to be doing. A stock going at a discount is a stock going in the complete opposite direction we want it to. When we buy a stock, we want it to move up in our favor. However, stocks that are going at a discount are actually dropping in price. A trap people regularly fall into is buying stocks that are going at a discount only to watch them continue dropping in price. Catching a falling knife, right? You should know the expression. And as you may have regularly experienced, a stock dropping in price will keep on dropping, potentially for weeks, months, even years. And so getting back to just break even in itself, well, is an impossible challenge. Let's look at PayPal, for example, a behemoth of a company. It climbed around 710% from its IPO to its all-time high in 2021, post-COVID. But since then, it has fallen off a cliff and is now trading just above its IPO price. Any investor who kept buying in as it got cheaper and cheaper would now be holding onto a stock at a significant loss, with it showing absolutely no signs of moving back to its all-time high anytime soon. Now, I know people who rode this all the way down. One even messaged me saying, "Surely it can't go any lower." My response, well, yes, it can. And now they are still waiting, still holding. Meanwhile, here's the thing, stocks like Nvidia and McKesson, a stock you may not be familiar with, ran right past them. This has two very serious consequences. First, you have risk and money tied up for zero growth. And second, you are missing out on putting that hard-earned money of yours in stocks that are performing far better than PayPal. And there are a plethora of them. We will look at the DNA of these top stocks shortly, so do stick with me. Now, in reality, the odds are stacked against you when buying cheap stocks because, as mentioned, they are going in the opposite direction. Buy low, sell high is actually a bit of a fallacy people buy into, and it's been touted as the status quo. Good investing is about stacking all the odds in your favor, and there is a way of doing this that trumps buy low, sell high. I'll break this down when we look at the DNA of top stocks in a minute. Now, some argue that you collect a dividend payout when buying these cheap stocks, but often these payments aren't large enough to make any real difference to one's financial future. Now, that gentleman, Warren Buffett, that everyone aspires to be like, collects billions in dividends, so can afford to hold the stock in a loss. But the everyday individual does not have that luxury. You really do have to look at whether Warren Buffett's approach is correct for you. I argue it isn't. Time is of the essence, and so you need a better, smarter approach. Okay, the next stock to pass on is one with less than 5 years of history. The reason is simple. There just isn't enough information to gauge how well the stock has performed. Remember, as investors, we want to stack all the odds in our favor so that when we buy a stock, we have a much higher chance of making a profit than a loss. A stock that has a repeated history of performing well is very likely to perform well in the future. Stocks with less than 5 years of history often do not have that. They tend to form bases and move sideways when they first IPO, and buying into these often leads to having your money tied up, which leads to the same two consequences I mentioned earlier. You have risk and money tied up for no growth, and you're missing out on better performing stocks elsewhere. Now, with around 20,000 stocks to pick from, we really do have the luxury of being highly selective. It's just a case of knowing what to look for and what to pass on. So stocks dropping in price and stocks with less than 5 years of history are a definite pass. But there is a third, those that don't display clean, consistent growth, even if they are moving up. These stocks tend to swing violently and wildly. They can and will hit stop losses before moving back up in our favor, and growth is painfully slow. Coca-Cola, Hilton, Marriott are all examples of these stocks. They have delivered well for their investors, but they have not been the smoothest ride, which has required immense patience. Stocks that swing wildly when moving up make it difficult to compound, which is to buy more of a winning stock. And that is a must to press home our advantage when in a winning stock. I'd go as far as saying it's criminal not to compound. We look at exactly how to do this when I break down the DNA of a good stock next. And again, with over 20,000 stocks to pick from, we can focus on those that meet all our criteria, including a steady performance history. And so to do that requires a checklist. If you want to filter your next stock the way I do, grab the free stock market blueprint linked below. It's the checklist my community and I use every single week. Now, here's where most investors get stuck. They may avoid the obvious mistakes, but they never build a system for spotting the winners. But that's what I'm about to show you, and it's where your portfolio goes from average to outstanding, from embarrassing to, well, take a bow. So as a reminder, stocks you want to avoid are stocks that are dropping in price, stocks with less than 5 years of history, and stocks that lack consistent trend behavior. Stocks that make it into your portfolio without fail look as follows. First, stocks that are already moving up and in our favor. Whereas buy low, sell high is touted as gospel, the true way to do it, and it gets no media attention, is buy high, sell higher, also known as trend following. It's an approach that has topped performance tables for decades, whereas buy low, sell high, or value investing lags well behind. Get some binoculars behind. You may not like to hear it, but facts are facts, and being objective is how investors become successful. Emotions will kill your performance, as you'll already be finding out. Okay, so with buy high, sell higher, we want stocks that have a history of consistently moving up and that have started a fresh new uptrend phase. There is a way of identifying these stocks which we call the 4PS method, which I will break down for you in a moment. Don't worry, I've got you, because there's absolutely no one doing this but us. And I'll be honest with you, I didn't always see it this way. I used to chase value plays thinking I was getting in early. But once I studied what top performing stocks actually do, the game changed. And what's even better, our community has been applying this method week in, week out, whether they're pros or just starting out, and they're getting the same kind of results that we are. And to show you how powerful this method is, we average over 30% a year, a track record which had our hedge fund approved in Luxembourg. So this isn't theory or back tested, this is the real deal. As I said, this is a simple and repeatable process that will change everything you know about picking stocks and do a 180 on your performance. Okay, so next we want stocks that have at least 5 to 10 years of history of moving higher, often much longer than that. And when you realize how vast the US stock market is when it comes to top performing stocks that get absolutely no media attention, you'll never go back to these slow, outdated methods that you are currently using. Okay, here's a pro tip for you. True wealth is made from these hidden gems that you won't find on Reddit or X. You will, However, find them on our socials because we are one of the very few who cover these stocks. And in this minimum period of 5 to 10 years of history, you want stocks with a clean performance history, where the ride has been pleasant and where compounding has been simple and straightforward. It should all make sense to you. Stocks moving up right now, stocks with a history of moving up, and stocks that move up with smooth structure. That is the DNA of a must-buy stock. Why would you want to buy a stock that is doing anything different? I can tell you why. Often your priority is to be right and not to make profit. And when you understand the distinction and make the necessary adjustments, well, your performance changes with it. So how do we identify these stocks? That's where our 4PS method comes in. I told you, I had you covered. Let's break it down. Every stock that has made it into our portfolio over the last decade follows the same pattern. Discovering this pattern was a complete game changer for me and how the 4PS method came about. All winning stocks go through 4 distinct phases. Phase 1 is a proven performance history over a minimum of 5 to 10 years. We covered that, right? Phase 2 is a sideways market, which acts as a base for the next leg up. Now, listen up here because this is where it gets interesting. Phase 3 is the move out of the sideways market, signaling the start of the next leg up. And phase 4 is when the new uptrend phase is confirmed and when we take a position. And remember, if phase 1 is smooth, then phase 4 is also very likely to be smooth. So really take a moment to study a stock's history, and once your eye is in, you can spot good stocks and bad stocks in seconds. Now, another pro tip here. I like to use the monthly time frame when applying the 4PS method, as that is where the DNA of the stock is clearly visible. Now, phase 4 typically lasts 12 to 18 months, often longer, which gives you an indication of our holding period for profitable stocks. Let's look at Nvidia, for example. It had its IPO all the way back in the 90s, so it definitely meets our more than 5 years of history criteria. It has had 3 major trends in its history: 650% between 2016 and 2018, 1,000% between 2018 and 2021, 1,200% between 2022 and 2024, confirming phase 1 of our 4PS method. So you can see how we are eliminating luck and narrowing down on structure. And when we find stocks that behave like this, holding and compounding becomes straightforward. Now, when we look at the structure of Nvidia's past trends, what do we see? Well, we can see that they are smooth and linear, which makes Nvidia, well, a very, very good hold. The way to recognize this is how the trend structure uses the daily 20 simple moving average and the daily 50 simple moving average as support levels, or trampolines to bounce off and keep pushing higher. And as Nvidia has a history of smooth trends, we know that it will be a gem of a stock for not just holding, but compounding. And so when it comes to compounding, how do we actually do that? Well, each time it bounces off the 20 simple moving average and the 50 simple moving average and breaks out and sets new highs in the trend, that is a new entry signal and an opportunity to buy more. So the history of Nvidia's performance confirms that this is just not a tech behemoth with a $3 trillion plus market cap, but a stock for any good investor's portfolio. Okay, let's apply the rest of the 4PS methods so that you see where the next uptrend and entry lie. As mentioned, the current phase 1 is 2022 to 2024, which is the recent uptrend. Phase 2 is the current consolidation it has been in since June 2024. Now, during this period, how many times have we heard finfluencers call the end of Nvidia? From DeepSeek to tariffs, all Nvidia has been doing is forming a base, which is perfectly natural given the 1,200% boom from 2022 to 2024. This is simply where patience comes in, something lacking in abundance for most investors, but handsomely rewarded when executed correctly. Phase 3 and phase 4 are what we are now waiting for. Phase 3 is when Nvidia moves out of this sideways market and onto new all-time highs. And phase 4 is when the uptrend is confirmed and when we enter. Now, we've been holding Nvidia since the start of 2023, so over 2 years, and have multiple compounds in play. We will add to these positions when the next uptrend begins. And remember, Nvidia has twice moved to $1,000 per share and had 2 stock splits. So don't be surprised if it happens again. Going back to what I said earlier, the goal is not to be right, but to make profit. When Nvidia sets up and meets our criteria, we take a position with risk and exit management both in check. If it fails, it's a small loss. But if it works out, well, that's where the magic happens. It's like asking someone out. They might say no, but what if they say yes? Surely worth the risk, right? Well, how do you increase your chances? Bring your A game, intelligence, style, kindness, health, the ability to provide, all of those good things. Think in probabilities and you'll be surprised how things turn around. Now, the best performing portfolios aren't built on hype, headlines, or gut feelings. They're built on repeatable patterns. What you've seen in this video is the exact DNA behind stocks like Nvidia that consistently deliver. And if you can apply that same structure, the 4PS method, you give yourself the edge most investors never find. But knowing the theory of this pattern isn't going to make you money. Execution is everything. And that's why your next step is key. Watch this next video to know how the smart money invest in stocks to get rich. It'll show you exactly how we look at the market, how we build positions, manage risk, and grow our portfolio with calm, calculated precision. If you're serious about moving past guesswork and finally compounding with confidence, this is where it starts. I'll see you in the next one.